We had UK unemployment figures this morning. Did you see my news quotes in The Guardian amongst other publications?
The Guardian's very Johnny Raymond,
Thanks.
isn't it?
iPaper, City AM.
What did you say?
Can't remember. Megan wrote it.
Did she?
And I checked it and said, yes, that's fine.
What did the data look like? You missed it.
It was okay. Well, I mean, it was not brilliant, but as you'd expect it to be. No worse than expected. Unemployment came down, but the number of people looking for work fell as well. So the number of inactives rose.
That's not great.
No. And a lot of that.
What are the inactives doing?
Well, a lot of them were student-y ages. 16 to 24-year-old inactive rate rose. So they're all off on ChatGPT, asking ChatGPT what jobs they can do.
Claude's doing all right, though.
Very good, Hughesy. Very good indeed. It's nice having you back. Oh, dear.
The cheap gags. What's going on?
Well, I was about to ask you about all your holidays.
I don't have holidays.
You had a week in...
Right. It was a training camp for my athleticism.
Right.
You know, it was a trip with a mate. It was a cycling holiday, but we did take it relatively well. Seriously is the wrong word. We were quite. We got up pretty early. Had a very nice breakfast every day, and then got on the road. So,
hotel?
Yeah, we were in a hotel in the middle of Girona. I mean, Girona is.
I've not been.
Not many people have because, I mean, it's a beautiful city, but there's not a massive amount to do, other than potter around.
It's quite hilly outside, is it?
Yeah, it is. You've got some lovely. You're sort of south of the Pyrenees. So some of the photos. Yeah. So that picture you've got in front of you is sort of the river that runs through it, and yeah, it's stunning. But you can see the snow caps of the Pyrenees still whilst you're riding. Got some very decent climbs. You're relatively close to the coast, and that coastline is beautiful. But it's just north of Barcelona. But
you flew to Barcelona.
I flew to Girona. Actually.
Oh, there's an airport.
Huh? Yeah, it's tiny, but it's a great. There are lots of pro cyclists and triathletes live there and runners because the climate's lovely.
Oh, it's part of Catalonia, not Spain.
Part of Catalonia. Yeah, it is. I mean, the food's wonderful. I tell you what, the coffee. There's lots of coffee snobs there. There's some lovely coffee shops. Espresso Mafia. Absolutely superb. I could sit in there for hours just drinking coffee, talking rubbish.
Good.
So no, it was good. How was your week?
Uneventful, I think. Got all the ISAs done for clients though, so I'm pleased with that.
Have you?
Yeah. So we've talked for 3 months about our impending trip to Australia to see my sister over Easter, which never went ahead because of all that's happening in the Middle East. So
I'm sorry to hear that.
Well, it is what it is. And so I spent the week after Easter doing all the ISAs for clients, first week of the tax year.
So they're all done?
Pretty much.
Got your valuation letters out?
Nearly.
Yeah, that's my big job tomorrow because I was away last week. Usually I'd have the data out.
But they're already sort of out of date because March the 31st almost coincided with the market load, and the market's bounced 5% since the end of March.
Yeah.
So they'll be getting them the 20th of April, 25th of April, already out of date.
Well, totally, because portfolios are all-time highs again.
They are.
And the other thing to note is the end of the quarter, of course, fell at an awkward time because the day 31st of March, the market had a massive rally.
It did.
But that's not picked up on our pricing for all of our funds. No. So, yeah, I've had a few conversations with clients just explaining why performance looks slightly below where it should be, and it's all to do with that timing. But actually, I think the clients I have spoken to are, bearing in mind what's going on in the world, are delighted that the portfolios have, there wasn't really much change, was there? Slightly negative.
Well, most clients have been asking me, why on earth is the market at an all-time high when the Strait of Hormuz is still shut?
And what's your answer?
I'm struggling. Well, we'll talk about it, but no, the rest of the world's doing fine.
We should probably introduce it, shouldn't we?
Yeah. We're a short time, aren't we? So, hi, everyone, and welcome to Taking Stock After the Bell, episode 63. Hughesy and I here to talk about what's been going on and markets and the Strait of Hormuz being shut and the Iran war and the US equity market being at an all-time high.
Indeed.
Where should we start? We'll start with chart 2, Alex, which is equity indices year to date. Last time we were on was pretty much at the peak, wasn't it? We interviewed John during it,
Yes.
but the one before that was pretty much
would
the end
have
of February.
Yeah.
So at the time, markets were flying high, and then obviously we had a wobbly March, to say the least. And April so far has been good. So year to date, emerging markets in the lead, up 13.9%. Can't quite read that. Japan up 10%, UK up nearly 8%, Europe up 4%, and USA up 3.5%, all in total return, including dividends, and in sterling. We can see there the March wobble from the peaks. Emerging markets probably fell the most. US fell the least. Europe fell quite heavily as well. And it's all because we have got an energy price shock. If you've had your head buried in the sand, there's been a war in the Middle East. 20% of the world's tradable oil comes out of the Persian Gulf through the Strait of Hormuz. We were all geographical and geopolitical experts at this point. And the price of crude oil in Europe went from $60 a barrel, peaked at about 115, and is back at about $95 today. The good news, I suppose, in this is that the oil price hasn't gone up as much as it went up in 2022 at the outbreak of war in Ukraine. But more importantly, for those of us in the UK and Europe, the big problem in 2022 is natural gas prices. And whilst natural gas prices in the UK pretty much doubled, they've gone up nowhere near the same degree as they did again in 2022. So at the moment, we're not quite expecting the same degree of economic damage as we had in 2022, are we?
No, not at all. I think, I've been slightly surprised by how strong the market's been, but I think investors and market participants have probably learnt from Trump historically on events that the taco trade.
Yeah, so this little taco acronym's been following him around since last year, coined by FT journalist Robert Armstrong, no less, and I actually read the original article.
Was that right?
Yeah. Trump always chickens out, for those who aren't fully aware. So the market is basically expecting, and we sort of had it to a degree, haven't we, a taco peace talks ongoing as we speak. They're off back to Islamabad. But actually still not really that much action going through the Strait of Hormuz. There's still a few more ships than there were, but nowhere near.
The US is still blocking parts of the Iranian ship movements, aren't they? To try and get some, to put some additional pressure on them.
And it's not just oil, it's also gas. It comes out of the Middle East, LNG from Qatar in particular for the UK. It's also the biggest hub for global fertilizer production, which obviously has potential impacts on food production, crops, and pricing, and food prices a little bit further out. Other areas like helium gas, for instance, all comes to the Middle East. And there's a few other sort of slightly more niche, yet very important stuff that comes through there that currently isn't. So in theory, it's quite bad news, and it is bad news. But the market, I think, is kind of looking across it. I mean, essentially what the market's saying is that if this is resolved relatively soon, like in the next 2, 3, 4 weeks, and the straits reopen, there will be a 6-month period where there's some shortages, but those will iron themselves out, and the damage on the economy will be very contained and very, to use that infamous term, transitory. However, if the straits close for more than the next few weeks, then potentially the impacts are somewhat larger.
And future oil prices are showing that as well, aren't they? They're substantially lower than where the current oil price is, and the market is pricing in some sort of resolution. I think even there's lots of different views on this, even internally. I think our oil and gas analyst is slightly nervous about this as well. He thinks it will rumble on probably, or basically the market's being a bit complacent on where it thinks oil pricing will get to, and this will take longer to unwind. I think, I as I said a moment ago, I am slightly surprised at how resilient stocks and markets have been based on what we saw in 22 with inflation and energy prices doing what they are. And if you go to the local petrol station, you can see how it's impacting us as UK consumers. So certainly inflation, we'll see it rise. I think,
chart 4, Alex.
Rightly or wrongly, we are looking through it for the moment and expecting, as we've said, a resolution and getting back to normal. But it's the market has sort of whipsawed a lot with every tweet or comment from Trump, which is, which makes our lives very difficult because there has been a lot of volatility, and it has, some clients have been concerned. Most, to be honest, have been relatively quiet. But I think, if you are reading the papers or looking at what markets are doing, there's quite a lot of volatility in price, which is, which doesn't make our lives particularly easy.
No. And I guess every professional oil and gas analyst, not analyst isn't the right word, but expert that I've come across, Middle Eastern expert, they've all said that the closure of the Strait of Hormuz is the single biggest thing that they worry about the most. And it's happened, and it's been closed for 6 weeks into February, 7 or 8 weeks. And yet the oil price, and I guess had you told them that prior to 20th of February, they would have said the oil price would be $200, $250, stock market on its knees, economy falling over. The oil price did go up, but it didn't perhaps go up as much as many thought. There have been, the Saudis, for instance, have opened up their pipeline to avoid, and there's been strategic reserve releases by the likes of the USA and Japan back onto the market. There's been some demand destruction in Asia. So there are mitigating effects of the lost, 20 million barrels a day of oil that have flown from the Persian Gulf. About half of those barrels are getting back onto the market. So the damage isn't as big as maybe people feared. But again, the longer it carries on, the greater the damage will be. And just to come back to the inflation chart on chart 4, we're actually recording this the day before UK inflation figures for March, which is very handy. But UK inflation currently is 3%, expected to be a bit higher. US inflation has already ticked up for the March number, so 3.3%. That's mainly through gasoline prices, as they call it, petrol. And it'll be the same here in the UK because we'll all have seen that prices of petrol and diesel have gone up quite a bit.
I guess on the other side, I mean, yes, sort of supply being restricted by this amount is hugely impactful on consumers and businesses. But a lot of the businesses that we do invest in will have energy prices hedged probably further out than they would have done before because of the event in 2022. And I wonder if, because the event happened in 22 and there was all the energy problems, that actually businesses have sort of protected themselves in a better way.
Adapted as much as they can.
Yeah, I think so.
Yeah, I agree with that.
And again, the leading businesses throughout global stock markets are probably less reliant on, certainly less reliant on oil as they have been previously. I think oil as a percentage of GDP is obviously much lower as well on a global basis. We would have, if you look at the big global leaders, which are mainly tech businesses, how much does the oil price moving around impact them? Not a huge amount is the truth of it.
No, but it just comes, it's disappointing from a UK domestic perspective because all the data that we've seen in the last month that reflect what was happening in January and February show that the UK economy was doing quite nicely, in January and February. Growth, we had February growth figures were very strong. Retail sales are very good. But obviously as soon as the war came along, petrol prices went up, consumers go back into their shell. We're not spending any more money because, rerun of 2022, here we come. So activity has fallen off a cliff, which is disappointing because the economy was beginning to get some momentum and that was reflected in.
Well, that's sort of a continuing theme in the UK, isn't it? It doesn't take much at all to kill confidence. And then it takes a long time for consumers to regain confidence. And as you say, there was some traction. And along comes this, which I think has...
one step forward, 2 steps back, right?
It does feel like that.
We had UK labour market data this morning. Unemployment surprisingly fell to 4.9%. We've got the chart here, Alex, on slide 6. Unfortunately, the rest of the detail of the labour market data wasn't quite so clever. Earnings growth was sluggish. The number of jobs or the number of vacancies advertised, number of jobs advertised was down. The number of PAYE employees, payrolled employees were negative month on month. The the detail of the unemployment of the data in general wasn't good. And again, that's from March, so that is at the start of the outbreak of the war, so that will be impacted.
You're actually saying it's youth unemployment that's being impacted the most, which is really worrying.
Yeah, absolutely right. It's so we'll just, I mean, the longer it goes on, the greater the damage to confidence, and therefore the longer it's going to take to recover. So we're all sort of sat here scratching our heads, wondering, why equity markets are going up. So,
of course, we're talking, how investors and markets are reacting, really with a main, with main reference to equity markets. Actually, bond markets are telling you a different story. They're not as, they're certainly not as positive. You've seen credit spreads haven't moved back. You put the chart here in front on government bond yields, and that move upwards hasn't reversed either. So I think, it's two different stories in a way. The bond market is definitely not as relaxed as the equity market about this event, and it's thinking a lot more about the negatives and the inflationary impacts than the equity market is thinking about.
Yeah, I actually feel that the bond market and money markets have actually overreacted in March. Back in March, we were expecting 3 rate cuts in the UK in 2026 to 3% at the end of the year, and 2-year gilt yields were 3 and a bit. As soon as the war kicked off, 2-year gilt yield roared higher, and the market was at one point expecting 3 rate hikes this year, which, I mean, is a rerun of 2022, but we're in a totally different economic environment to 2022. And I certainly felt that was a massive overreaction.
And also rates were at a very different level.
Yeah.
In 2022, rates were virtually zero.
And now they're 3.75%. The Bank of England, with the labour market being as weak as it is fundamentally, and confidence, we're in a very different environment to 2021 too, when we had the reopening from the pandemic. Everyone was scrambling to get back outside, and loads of people had money in the bank from forced saving, and they were going out spending money.
It was also a supply shock issue, that there weren't enough goods to buy.
Yeah. So the idea that we were going to have 2 or 3 rate hikes this year from the Bank of England in particular seemed a stretch to me. The market has moderated its view, and I think the market's now at 1 rate hike this year. I'd still be surprised if we had rate hikes this year.
I was going to ask you that, what you think. You think it would? You don't think there'll be a rate hike this year?
I think the Bank of England will have to look through this, and this will be, rates are high enough as it is for the state of the economy in terms of unemployment market and growth in general. And I don't think, again, come back to the point, if the Strait of Hormuz is still shut in 3 months' time and the oil price has gone up to $150, $180, and it's a different conversation. But if it hangs around the 95, Strait gradually reopens within the next 3 months and the oil price moderates, then I think the Bank of England will probably be back on rate cutting watch by the autumn.
You think central banks, or Bank of England in particular, is more worried about growth outlook than inflation?
Because the growth inflation mix here is worse than it is elsewhere. We don't have the strong level of underlying growth that they do, particularly in the States.
And in the US, what's your view on the Fed?
Well, today or yesterday, we've got the new man, Kevin Walsh, who's being sworn in.
I think it's today.
It's today.
Yeah.
So he's at the Senate today. It's exciting. So we've got a new man, and we don't really know. Obviously, he's a Trump appointee, and Trump famously wants lower rates. And that, Walsh wouldn't have been appointed by Trump if he wasn't necessarily going to push in that direction. But the fascinating bit is, if you look back at what Walsh has said over the last 15 years, he's been a very strong money, hawkish person in terms of he wants to reduce the balance sheet. He wants higher interest rates. He's not one for lower interest rates historically. So quite frankly, you have no idea. Just because of the change. I think Jay Powell...
I think we'll say no rate change.
I don't think... I'd be surprised unless, again, if the Strait's still shut in 3 months' time, the oil price is up and the economy's softening. It's a different story.
I mean, the elephant in the room, in a way, is how quiet China has been. Because China buys 80% of Iran's oil.
Yeah, a lot.
It actually has, in terms of storage, I think, in terms of number of days, the longest storage rates on a global basis, something like 180 days, I think.
Yeah.
But they will be desperate for something to be done, because they can't, whilst they have 180 days, they are so reliant on Iranian oil compared to any other country.
But they'll be pulling in more Russian oil as well at the moment, though.
That's true.
So that's a good release valve for them. They're in a very strong position because they've had the foresight to build up their reserves. So, yeah, you're right, though. China does sort of hold a key, and I'm surprised they haven't been a little bit more forthright.
Well, I wonder if they have been, but behind the scenes.
Yeah, possibly. So, I mean, Hughesy, you come back to the main question. Why have equity markets been going up despite the world?
Tell me. It's my question. I mean, we've had analysts, haven't we, raising across the tech names. So we've had some decent earnings growth expectations. That's obviously more linked to the US. You've put the chart in.
I'll put this chart in here now, yes. Bear with me. Slide 7, Alex.
Yeah, so the US...
The yellow bars we're looking at here. So earnings US for this year are expected
to be almost 20%.
Growing 20% year over year.
Yeah, which actually... And actually that's upward revision from the start of the year.
Yes. So the start of the year, the world was expecting about 14% profits growth in the US, and that's now 18%.
Yeah.
So basically, as the first 2 or 3 months of the year have gone on, despite Iran, analysts are expecting profits to grow by more than they were at the start of January.
Yeah. And as a result, multiples have become cheaper, despite markets going higher. So actually...
So the forward P on the global equity market, MSCI ACWI chart here, chart 9, has fallen to 17.8 times from over 19 at the start of the year.
Which is certainly more palatable from investors' point of view. I mean, our concern for a few years ago and even 6 months ago was where US valuations had got to, and it was always can earnings almost grow into the valuation? Exactly. And that is happening.
Yeah.
And actually, if you look at the largest technology stocks, the Mag 7 in the main, they are the cheapest they've been for a long period of time. Names like Microsoft and Nvidia are actually trading at they're trading at cheaper valuations than the market valuation as a whole for much larger growth rates. So we've actually been really fortunate in terms of the timing of this war that equity or earnings estimates have grown much quicker than we were thinking at the beginning of the year. So that really has sort of propped up markets. And then against that, the UK has a pretty large weighting to oil and also to defence names. So that has sort of kept the FTSE quite resilient as well. We've also got very good earnings estimates for next year as well. Lower than the US, which is why the multiple's lower. But the screen we've got in front of us, the FTSE is still showing an anticipated growth rate. What's that, for 14%?
14% for this year. Yeah, slide 7 again. Yeah. 14% growth for the UK market this year for earnings, 9% for 2027, which is the green bars.
And Eurozone, we're almost 15% for this year and 12% for next year. Yep. We've got, emerging markets. We're expecting a massive number this year, which is mainly due to a handful of companies, which is TSMC,
Taiwan Semiconductor, Hynix, Samsung, Tencent, and Alibaba, basically the big emerging market tech stocks. Again, and comes back to the AI trade a little bit, doesn't it? Yeah.
And as I said, 44% earnings per share growth anticipated this year, and what's that number? 18% next year.
Yeah. Yeah. I mean, basically, the long story short is that whilst the equity market has gone up, the expectations for profits has gone up by more.
Yeah.
So actually the market is cheaper today than it was in January. So the market's higher, but the market's also cheaper. And therefore the market's cheaper because of the increase in the fuzziness of the outlook.
Mm-hmm.
Does that make sense? The geopolitical volatility. But absent the geopolitics, again, to come back to this point, part of the reason why the market's rallied is that the market thinks that Trump is going to fudge some sort of deal and TACO, and therefore we can get back to looking at the fundamentals, which are going the right direction. The economic impact of Iran is transitory, essentially. World goes back to normal, and equity markets also look a little bit cheaper than they were. So we're off to the races again. That's the bull case. And that's why the market has been slightly reticent to sell off too much, in my opinion, because it doesn't want to get caught the wrong side.
Yeah, I would agree. I think... I think the market's view at the moment is there will be a resolution relatively quickly, and the world will go back to something similar. I don't think it will be the same. I think what happens in the Strait of Hormuz. That's we're yet to see what happens there. But I think things will change, and I think countries will have to think about their energy sources going forward again, as they did after Russia, and potentially think about new pipelines and new access to oil. Whether that means the UK has to open up the North Sea again, or consider that, or maybe it pushes us even further into the green agenda and using more renewables going forward. But only so much of that we can do.
Yeah, I don't quite know enough to be able to give it. Ed Miliband would definitely say that we can't be reliant on fossil fuels and we need to have more homegrown energy, and he's kind of right. The problem is that the intermittency and the foundational cost that renewables, it costs a lot of money to build your baseload and have this structure in place. For me, it comes back to this point about the world is a more dangerous and volatile place. And for instance, a good example, we import a lot of diesel. We import nearly all of our fertilizer. We no longer have any fertilizer plants here in the UK. So you're now relying on the boats coming in and out of wherever they're coming from to get the stuff you need to grow the food to feed your people. And it's the same if you look at steel, chemicals, all these sort of basic industries, and they are like basic in the sense of they are the building blocks. If we don't have those on our doorstep where we've got access to them 24/7 and something goes wrong somewhere, we're in a spot of bother, to say the least. So are we going back to a world where we need to start rebuilding this stuff that we spent 20 years closing? I don't know. For me, that's a sort of bigger picture that I hope.
Yeah, there was a lot of talk of reshoring, wasn't there? And after or around COVID, because we were so reliant on China, I think some of that's happened. Certainly from a US point of view, things like fabs being built in the US and that sort of thing. We do. Yeah, we've got a huge potash mine being developed, haven't we, in
North Yorkshire, under the moors.
And is that BHP?
Anglo-American sold it to BHP.
I think it's BHP.
Yeah,
but they're developing
the Woodside project. It's got a really good website if you can have a look.
Yeah,
they're building a 10-kilometer underground tunnel to Whitby, I think it is, on the coast, to get this stuff underground. Yeah. It's going to be amazing, but it's going to take years to develop.
It will do. But there are small changes being made. But I think, as you say, it's a big picture stuff. We need to be less reliant on, I guess, things that are out of our control, countries that have the ability to block or stop really important produce from coming in.
But it's a sort of, as I keep coming back, that sort of post-fall of the Berlin Wall era of globalization and outsourcing and lowest cost producer. It's getting us into a point where that is now beginning to reverse and roll back. And and the reason that we outsourced everything is because it was cheaper. Cost of stuff has gone down. We had 20 years of low inflation. If we start reversing that, that is fundamentally more inflationary, i.e. things are going to cost more, because it does cost more to make fertilizer in the UK than it does in Qatar. Simple as that.
Totally.
So I don't know. It's a bigger. Maybe we should get someone on to talk about that. Maybe the politicians understand this stuff. Maybe they don't. Who knows?
That's a good question.
One to worry about for the future.
Probably what. Got anything else to cover?
No, not especially. We've got UK unemployment tomorrow, so that will be UK inflation tomorrow. So that I can't imagine that'll be good news. But
there's still a lot going on in software and AI competition. But we have Ben Rogoff from Polarcap Technology coming on in a few weeks, so we thought we'd save
the tech chat.
Yeah, for anyone that doesn't know Ben, he is lead manager on Polarcap Technology. It has an extraordinary track record, and what he doesn't know about tech isn't worth knowing. Yeah. So that will be a really interesting conversation. We could talk a lot about that between ourselves, but we should wait. But otherwise, I think I'm very pleased with how resilient markets have been. Somewhat surprised, but as we're running through these slides and talking about valuations and earning expectations being uplifted, there is rationale as to why they're holding up well. And again, as a starting point, you've got yields on short-dated gilts and bonds looking very attractive for clients that want to take less risk. And on the other side, equity markets are trading at cheaper levels.
Not without risk, because if this stuff carries on, then the equity market might well roll over again. But you can buy a 2-year gilt UK government bond today for 4.25%. It was 3.5 in March, February.
That's a big move.
Gone up a lot. It's okay. It's not going to set the world alight, but short-dated gilts, everyone's favourite.
You love a gilt.
Everyone's top trade. And we've got a very exciting episode that we're recording on Friday, which will probably come out a week after this, won't it? Which we did a bit of prep for that today. So a behavioural financial psychotherapist, I think is their official title, who's going to talk about the psychology of money, which I think is going to be brilliant. I'm very much looking forward to. In the meantime, we've got to get back to our desks, we find out what's happened since we've been recording. So thank you, Hughesy. Thank you very much, everyone, for watching and listening. Yeah, it's nice to be back, and we will see you next time. Thanks very much. Any questions, let me know. Jonathan.Raymond@quartercheviot.com. Thanks very much. Bye-bye.